Hi everybody, and welcome back to these videos going through lecture number 3, where we're covering a variety of different aspects of IFRS 17. So we talked about profit timings initially, so how our CSM approach to the CSM releasing its profit each year might change, depending on, in our example, lapses and decrements like mortality. We then covered in the last video groupings, so the fact that when we're working out CSM type stuff, the contracts that we have on the books need to be grouped into at least 3 different groups. And those minimum number of groupings are called group 1, 2 and 3. The first one being contracts that we are really confident are going to be profitable in the future. The second is contracts where we are really confident they're going to make losses over the course of their lifetime. And then the third one is the group of contracts where we expect them to be profitable. And you could add other groupings to this as well. So in this video, we're going to move on to yet another new subject. We're going to talk about alternatives to the CSM approach. We might also include the data and administration, but I think we might just do this kind of first section. So let's kick off with that, give ourselves some space, and we're going to cover alternatives to the CSM approach. Okay, so first bullet. The approach to the CSM we have described so far is called the general measurement model, which I'll give the acronym GMM, or you'll hear it called the building block approach. Now, part of the reason for going into that in so much detail is that, or the CSM in so much detail as we've done in the last couple of lectures, is that that's what we typically use for life insurance. However, you can do something simpler. So, however, you can use a simpler approach called the premium allocation approach, or PAA. If you expect it to give the same results as the GMM, or let's put in a colon there, semicolon here. If you expect it to give the same results as the GMM, or your policies have terms less than or equal to 1 year, which are essentially, if you've got a term less than or equal to 1 year, that's general insurance. So just to make this kind of clear, to finish it off, it is common to use PAA for general insurance and GMM for life insurance. Okay, so basically just some terms that you need to be aware of. What we've been talking about so far, you might hear being called the building block approach or the general measurement model. There is a simpler approach that you can use instead if it's going to give the same results as the GMM. That's called the PAA. But you can also use the PAA for policies that have terms of less than or equal to 1 year. So we end up in this situation where often the PAA, which I haven't gone into in any detail here, I'm just telling you what it's called, will be used for general insurance, and the GMM will be used for life insurance. Okay, let's stop this video there.